Well, thank you. Thanks for the opportunity to present the paper. This is joint work with my former student Yuree Lim, who is on the call and is going to respond to some of the questions via the chat. So, uh, so the market for private security issuance has grown in size and importance. It has grown very rapidly, so much so that it has now become bigger than the public market. So, for example, in 2017, private markets in the US raised about $2.4 trillion, while public markets raised $2.1 trillion. And out of this $2.4 trillion, about 70% of that was raised via private placements, and the remaining was raised via crowdfunding and initial coin offerings and debt sales to large investors. So under so starting on September 23 of 2013, under Title 2 of the Jobs Act, non-public companies, so private companies, can sell securities via general solicitation. That is, for example, by advertising in the newspapers or on the internet, but only to verified accredited investors. However, so far there is essentially no empirical evidence on Title II's effect on small business funding. So this law was passed, or Title II of the Jobs Act was passed to increase small businesses access to capital, and so far we don't know how that is working. So as far as we know, this is like the first empirical study to look at this data and to ask this question. So, moreover, while the market for private placements has grown in size and importance, its full extent and functioning and the role of financial intermediaries in this market have not been systematically investigated. So, this is, as I said, this is the first large-scale study to analyze these issues for small companies. And this topic is also of interest to market apart from academics, the academic literature. This is a topic which is also of interest to the participants in this market, namely investors, entrepreneurs, and brokers and dealers, as well as regulators and policymakers. So unregistered offerings, unregistered offerings made under Rule 506 now after Title II of the Jobs Act can be done via these two rules, two alternative rules, the Rule 506C, which was introduced by Title II, and the earlier Rule 506, which has now been relabeled to 506B under Title II of the Jobs Act. Okay, so what is the, so these are sort of the two main avenues of issuing, of fundraising for small businesses under Title II. So what is the difference? What are these two methods of raising capital? So under Rule 506C, companies, so businesses can sell only to accredited investors. See, and whereas under Rule 506B, they can sell to accredited investors as well as up to 35 non-accredited but sophisticated investors. Now, so this is an important distinction. So, who are these accredited investors? So, an accredited investor is an individual who has a net worth excluding their primary residence of more than $1 million, or they have an annual income for each of the last 3 years of over $200,000 or $300,000 with his spouse. See, so if an individual satisfies either of these requirements, then they become they are treated by the law as an accredited investor. Now here is there is another important wrinkle. See, so under uh, so the verification of investor accreditation. See, so this is sort of a key distinction between these two channels for raising for doing private placements. For these firms under Rule 506B. Under Rule 506, under Rule 506C, the issuer needs to verify that that an investor is accredited. See, and that process of verification is very elaborate. So the issuer needs to so how do you need to verify? With documents. So so the verification can be via a letter from the investor's accountant, lawyer, or investment or tax advisor, or via bank or brokerage statements, tax returns, credit reports, etc. Okay, so these are individual accredited investors. Now, besides that, you have certain banks, insurers, registered investment companies, partnerships, corporations, non-profits, or trusts. Those are all also accredited investors. So, so the verification of the investor. So the issuer needs to verify under 506C that the investor is accredited, whereas under Rule 506B, it is just a checkbox. The investor simply checks a box on the application. Okay, uh, uh, so investor just self-certifies by checking a box on the application for the shares, issued by the issuer, to say that they are accredited investors. Now, as far as non-accredited investors, so they need to be sophisticated investors. And again, this is a checkbox saying that you understand, you have basic understanding of finance and markets. Now, then another key distinction between the two is advertising. So the formal name for that at the SEC is General Solicitation. So, so the thing is with Rule 5, under this channel, the issuers are allowed to advertise. So any type of advertising. So advertising via newspapers or the media or the internet. Whereas in the regular channel, Rule 506B, no advertising is permitted. Okay. Okay. So are there questions before we proceed?
We don't have a question right now, but I have a question, Anup. Like, apparently there are multiple things that are changing here, like accredited investors only or issuer must verify. Do you have evidence which one is driving what? Like, do you have a chance of disentangling like where the effects are coming or which one is
Okay,
driving
so
what?
yeah, it's a very good question. See, so the best that we can tell is it is this investor accreditation which seems to be driving the results. So this is as you can see, this is like an elaborate process. Uh, so we cannot tell this with 100% certainty because we don't have information on advertising. See, what we can say for sure is that the differences that we find in the paper, they are coming from from this need for verification of investor accreditation and from advertising. uh, However, we suspect, everything that from everything that we know, uh, our best guess is that it is coming from this need for investor verification. And you will see this as so we'll see this as we go through the results.
Okay, thank you.
All right. So the hypotheses, the issues that we are looking at. So the first hypothesis is that you might have a separating equilibrium where low quality firms they tend to choose 506C offerings. Why? Because they're not part of an existing, they don't have contacts with investors, and the firms are not well established. They are younger firms. They don't have they don't have a lot of revenue and so forth, and therefore they are not attractive to investors. So they're not part of an existing network of you see, they're not attractive to the investors, and so they need to advertise, and they need the help of financial intermediaries, uh, and advertise in order to find investors. Whereas high quality firms, they are already attractive to investors, so they don't need to advertise, and they may sort of congregate toward 506B offerings. But we don't have strong priors on this, because the whole purpose of the law uh, is to increase access to financing to firms which are not well connected, which are not, which are not necessarily well known to investors. So the paper by Chan, Siegel, and Thakur, so they argue that small firms might they find it harder to raise capital due to information asymmetry with potential investors. Uh, then the second hypothesis, so again, this is like a two-sided. So these are sort of uh, it's a two-sided hypothesis. Uh, so the question is, how does the rule relate to the success of firms in financing? See, so one argument is that securities offered under Rule 506C have less success in financing, and the reason for that is information asymmetry, because investors are reluctant to invest in startups because they have less information about the issuer's prospects than the issuer. And also because of local bias in funding early stage investments. See, so advertising may not help small businesses raise more public capital because of investors' local bias, because investors prefer making early stage investments in local firms, as Lin and Vishwanathan they have found. Now, alternatively, Zheng argues that the Jobs Act can have a positive impact on capital formation and investor protection by allowing firms to publicly solicit and advertise, which suggests that securities offered under this rule, which allows advertising, have more success in financing. And then the third issue is about brokerage commissions. So firms without social or professional ties to investors they need to rely on general solicitation to raise capital, uh, as well as because of because of the need to advertise, and the need to advertise and to verify investor accreditation, the brokerage commissions might be higher, for these type of offerings. And then the fourth issue is, do these offerings that do 506 offerings that pay larger brokerage commissions have higher financing success rate? So again, here there are arguments which suggest that they should have higher success rate. So, for example, Bergstresser, etc., they have a review article where they argue that investors benefit from brokers via lower search costs. However, the alternative may be true as well. So, for example, Bolton and co-authors, they find that brokers do not deliver substantial benefits for investors who pay higher fees to them, and therefore 506 offerings, C offerings that pay bigger brokerage commissions may have lower financing success rate. Okay, so the main findings, so here are the main findings of the paper. We find that 506C, that is general solicitation offerings. So issuers in these offerings, they tend to be of lower quality. What do we mean by lower quality? So these are our main measures of firm quality. So one is revenue. So remember, these are startup firms, startup businesses. They don't have a lot of revenue. So we see. So revenue is a key measure of firm quality. So they tend see. But these are several of the measures of firm quality. So these issuers tend to have lower revenue. They have fewer prior investors. They have longer offering duration. So offerings that last for over a year sometimes. See, so longer share of offerings that last for more than 1 year, and they make more debt offerings instead of equity or option type securities, which is another measure of firm quality. And then after accounting for selection effects, 506C offerings have a lower funding success rate than 506B offerings. And this is a consistent result, sort of no matter how we try to do it. And we have done it in a number of different ways that I'm going to share with you. There is less capital than 506B offerings. They incur higher broker fees, that is sales commissions plus finder's fees, and that appears to be due to the cost of verifying investor accreditation. And the higher fees do not lead to greater financing success. And these findings are contrary to the intent of Rule 506C, that is, which was introduced by Title II of the Jobs Act, which was created to increase the small businesses' access to capital by letting them tap a wider investor pool. Are there questions before we proceed?
We have one question, Anup. The first one is, the second will be mine actually. How much funding is being raised from existing security holders?
How much funding is
being raised from existing security holders?
Existing security holders. Okay, you mean before the offering or as part of this offering?
As a part of the offering.
As part of the offering. Okay, I don't think we have information about this. See, so our data is from Form D filings. So as far as I know, this information is not there in the Form D, but we can check.
Okay, thank you. Another question is, could you please explain more how advertisements of offering are related to information asymmetry? What are the disclosure requirements under 506B and C?
Yeah, so under 506B, you cannot advertise. You can advertise under 506 under Rule 506C. See, so this is that's why these are known as the general solicitation offering. So this is advertising was allowed for the first time by Title II of the Jobs Act, which became effective in September of 2013. Now, more than that, unfortunately, we don't have a great deal of information about advertising. We would like to get, but the form. See, our data comes from Form D filings, which don't have more information on advertising. So all we know is that these offerings you can advertise. whereas 506B offerings you cannot advertise. But we have a large sample and we don't have systematic information on on advertising, how much money is spent, what type of advertising, and so forth. I guess we could collect anecdotal information, but we don't have systematic information, certainly.
I see, Anup. Another question is, apparently there are firms that raise capital under both exemptions, right? That's what you say in the paper. How many firms are there like this? And do we see how much they raise under both exemptions
Yes,
separately?
yes. Yeah, that I'm going to, I will show you. So that's a good question. And, I'm going to come to that. That will be toward the end of the seminar. Okay.
Okay,
So,
thank
but
you.
yeah, but I'm going to present those results. All right. So identification concerns. So obviously the choice between these two offering methods is not a random choice. So firm characteristics. So you have these two identification concerns. One is this, or two related identification concerns. One is the selection effect, that is firm characteristics that lead some firms to choose 506C may also affect their success in raising capital. And the other thing is omitted variables that related to that is omitted variables, that is characteristics of firm or the issue or a particular offering or the project, whether they are observable or not, may be related both to the likelihood of claiming this 506C exemption and that is choosing 506C as the offering method, as well as the likelihood of financing success. Okay, so these are the identification concerns. Here are our identification approaches. So in our baseline analysis, we control for a number of measures of firm quality, such as firm age, revenue, the number of current investors, offering duration, and the type of security offered. And we include fixed effects for the firm or the industry, and the state of the firm location, and the year, the year fixed effects. Second, we have a set of three different DID, PSM and DID analyses that I'm going to show you. And then finally, we look at a subsample of firms which make both types of offerings in the same year. And I'm going to describe these tests in more detail to you. Okay, so sample and data. So the data comes from these Form D filings over this period 2010 to 2019. So under Rule 506 of a Reg D exemption, firms can offer and sell securities without registering them with the SEC. For each offering, a Form D has to be filed within 15 calendar days after the date of the first sale to an investor. And the source of this data is the Audit Analytics private placement database. The sample and the data. So see, this shows the number of unique issuers. See up to this bar here. So these are firms which were issuing under Rule 506 before Title II was adopted in September of 2013. See, so after September 13, this old Rule 50, what used to be Rule 506, that became Rule 506B. It's so basically Rule 506 got renamed to Rule 506B after the adoption of the law, and there was a new rule introduced that was Rule 506C. See, so 2013. So this is part of the year was done before the Jobs Act and part of the year was done after the Jobs Act. So this dark bar here at the bottom, it shows the number of offerings under 2013. So it just began in 2013. So that's why there are such, such a small number of offerings. And then these are offerings under 506B after Title II was adopted in September of that year. And then after starting in 2014, the offerings are either 506B or 506C. So the number of 506C offerings, it sort of increased, in 2014 because this is for the full year, and then it has remained roughly similar over the years. You can see also another thing to notice is that even after the introduction of 506C, which allows advertising, 506B offerings tend to be used more commonly. They tend to be the predominant financing method. So just by way of background. All right, some summary statistics. Univariate comparisons. This is just like a smell test. Smell test before we do any formal tests to see if there is something going on. So this is just a comparison of after the adoption of Title II offerings under 506C versus those under 506B. So this table shows the mean and median values. Mean value for each of these two and the t statistics, and then the median values and the Wilcoxon test p value. See, so you notice that the success rate of the offering, what is that? That is just the amount of money which was sold under the offering. So dollar sold divided by dollar offered. See, so the success rate of the offering is about 28% on average. Under 506C, it is about 45% under 506B. And the difference is statistically significant. So lower success rate, and then the difference is even more stark if you look at median values. And then in terms of the dollar amount of the offering that was sold, so this is the money which was raised in thousands of dollars. So it was about $3.4 million here. It was about $2.8 million. This is let's see. So this number is kind of misleading, because this is driven by some extremely large offerings. See, so this is the more relevant number to look at. So if you look at the median values, so the median amount raised here was $30,000. The amount raised here was $225,000, and the difference is highly statistically significant. So these are our two main outcome measures: the success rate of the financing, which is, as I explained, it's just the what percent of the offering of the amount that you were trying to an issuer was trying to sell, was it able to sell, and the dollar amount that was raised. Another interesting thing to notice is the fee. See, the fees are huge, 45% in terms of mean, and for 506C offerings, and 26% mean for 506B offerings. The median values are a lot smaller. Okay. This is a similar comparison between 506C offerings post-act versus 506 offerings before the act. So 506 before the act, so those are basically like 506B offerings, and you get so you have a similar picture there. Okay. So the first, this is sort of our baseline result. So determinants of the, I'm sorry, this is like determinants of the choice of the general solicitation method. So what, see, so this is what types of firms choose a 506C offering. See, so here, this is a logit regression uh, of the choice of a of a 506C offering. So the dependent variable is a 506C offering, which is equal to 1 for 506C offerings and 0 for 506B offerings. Okay, uh, and let's see, and here this is an OLS regression with firm fixed effects. Here we have in this regression we have industry fixed effects in the state of firm location fixed effects, and we have fixed effects for the security type as well as fixed effects for the year. Okay, so the things to notice here are, so firms which choose 506C offerings, they tend to have lower revenue. So so by the way, so this is revenue range. See, so we have limited information. We don't have information about the exact revenue which these firms had, but revenue is disclosed in Form D filings in ranges. So under $1 million, let's see, I can tell you. So the revenue ranges are yeah. So it's a categorical variable. So it's equal to 0 if the firm has no revenue. It's equal to 1 if the range is if the revenue is up under $1 million. So between $1 to $1 million, that it's equal to 2 if the range is between $1 to $5 million, 3 if it is $5 to $25 million, etc. Okay, so it's a sort of categorical variable, all we know from this is that so these firms have lower revenue. They have fewer existing investors. They try to raise more money. They have larger amounts that they offer, and these offerings, they have a larger percentage of offerings which are open for more than 1 year, and they have fewer first round offerings than 506B offerings. All right. Then next, the cost of general solicitation. Brokerage fees. So this is brokerage fees plus the finder's fee. See, so so here, so this is a logit regression where the dependent variable is a dummy variable for zero fee. So zero fee offerings. So the 506C offerings are less likely to have a, there are fewer of zero fee offerings. Now, in terms of the dollar amount of the fees, so the fees are larger in 506C offerings. And you see, so this doesn't control for the amount, for the size of the offering. So the percentage fee is also significantly higher for in 506C offerings.
Anup, there is one suggestion and one question. The suggestion is about the advertising. Basically,
Yeah.
one of the participants says that people use Kantar advertising database that tracks advertising on a daily basis, which basically can help you for the advertising channel. And the question is about, whether do you have data about how firms identify which broker to work with and the nature of the contracts they enter into, how much commission has been paid, who manages the advertising, is it best effort or not, these details.
Yeah, so we let's see. So can you? So you, so Nuri, you mentioned like 3-4 things. So can you say that one more time? Those 3-4 things.
Actually,
so data on.
I can unmute Naveen and actually can
Data,
ask.
so I caught the first one. how do firms identify a broker? Okay, we don't have information on that. Uh, okay, and then after that you had, let's see.
Anup, Naveen here. So I was asking the question.
Yeah, hi,
So
Naveen.
can you hear me?
Yes, I can hear you.
Okay, so I was just curious because you actually showed that they actually end up paying about 45%. I didn't know that when I asked the question, but I was interested in knowing who
Yeah.
manages the advertising. Is this a best effort? I mean, what exactly are the brokers doing in this particular in these particular cases?
Yeah, I think so. I think one task that the brokers have is see. Uh, so the so it, again, it's a, I mean, this is an interesting. This is a very good question, Naveen. See, so the all we know is that advertising and investor verification, they are both done between the issuer and the broker. Our understanding is that as far as the investor verification, it's done primarily by the brokers, and the advertising, it's done together by, like, so we don't I don't know the answer to that. Like, it is done between the issuer and the broker. Now, who does it? So we don't have data. We don't have data on that,
So,
because
so
our
Anup, just as a
data comes.
follow-up, so are there a lot of these issues which are done without brokers?
Uh, the I don't. I'm not sure. I don't think so. I think there are brokers. These offerings typically involve 506C, particularly offerings. They typically involve brokers.
Oh,
And
okay, because I thought that if they were such, you could actually sort on that and see whether that
yeah,
could be an important
yeah.
information.
Okay, sure. Okay, that's, yeah. We can look to see. So. Uh, our- okay.
Yes, this was the last question. No, we can move. Thanks.
Very good. So, uh, okay, so 506C. So this is without worrying about identification. See, so in the baseline tests, 506C offerings. So they have lower success rate and they are able to raise less money. And they tend to be lower quality issuers. Then the next question is, do new entrants successfully raise capital under the Jobs Act? See, so here the issue is, this 506, so title 2 introduced this new rule, this new way of issuing capital via by advertising. So this would now, it gives a chance to companies that could not raise capital before, to try to raise capital. Startup businesses that didn't have access to capital, to try to raise capital. You have new people, new issuers coming in the market, new businesses. So are they more successful, in raising capital under the Jobs Act? And here the evidence is mixed. So while see, so let's see. So the dependent variable is success rate, and then we add a dummy variable for entrant, and an interaction term with Rule 506C offering. So an entrant is a firm that appears in the database for the very first time. So the very first time that so this is like an initial offering. The very first time an issuer, a small firm, a small business tries to raise capital in via this Form D exemption, so that they are captured in this database. See, so we find that the success rate seems to be a little bit higher for entrants. However, they are not able to raise, there's no evidence that they are able to raise more money. Then success and cost of general solicitation. So this is the issue. If you pay higher brokerage fees, are you able to raise more capital? And the answer to that is no. So here the dependent variable is the both outcome measures, success rate and the natural log of 1 plus the dollar amount that was sold. And on the right hand side, we add a variable for the natural log of 1 plus fee and its interaction with this Rule 506C offering. And we find that despite paying higher fees, 506C issuers have lower success rate, and they sell less, they're able to raise less capital. All right. So now about identification, more formal tests for identification. So we do we have 4 tests. So these are the 3. These are 3 of them, and then the last one I will show you, which is firms which use both types of offerings in the same year. Okay. So the first identification test. So this is between switchers versus stayers. So what we do is we match each switcher that is treated offering to a stayer that is control offering from the same industry and the same year using the propensity score matching method. So what are these switcher offerings? So this is if a firm was using 506, if a firm had issued under Rule 506 before the law was adopted, and then after the law was adopted, the law introduced the new Rule 506C. So if the firm switched from being a 506 issuer to a 506C issuer, so we call it a switcher. So these are switcher offerings, and then the stayers are stayers which we treat as control. So these are firms that were issued under Rule 506 before and stay under the new the relabeled Rule 506B after the introduction of the law, after the introduction of Title II of the Jobs Act. So we match each switcher to a which is treated offering to a stayer that is a control offering from the same industry and the same year using the propensity score match method, where we do matching. We match based on a range of firm characteristics, a whole bunch of firm characteristics. Okay, so this is let's see. These are the so this is so here you have 2 things. So this is first, this is like a univariate comparison, and then these are regressions. So we have in the sample we have 781 pairs of switcher and stayer offerings, and and this is the significance level of the difference between the two. So they tend to be similar. The only thing which is different is the amount of money which is the dollar amount of the offering between the two. Now so then when we do our main outcome, regressions of our main outcome variables, that is success rate and the dollar sold, natural log of 1 plus that. So the treated offerings, that is the switcher offerings, so offerings which switch to the new Rule 506C after the adoption of the law, they have lower success rate and they are able to raise less money. Okay, then the next test, this is a propensity score matched sample, and then difference in difference test, PSM DID test. So here treated firms are 506C offerings post the after the law, after the adoption of the law, and the control firms are PSM matched 506 offerings before the law, before the adoption of the law. See, and so again, you have here, these are the univariate tests of differences, and nothing is statistically significant. See, so these characteristics are very similar between the two types of offerings. When you do regressions of our outcome variables, the success of the offering. So in terms of the success rate, there is no difference, but these offerings are the 506C offerings are able to raise they raise less money after the adoption of the law. Then the third test, so here what we do is our treated sample consists of both post and both after the law and before the law. See, so the treated sample is 506C offerings after the law, which we match with 506B offerings after the law, and then we have so to this we add matched 506 offerings before the law, and here in the control sample we add the non-matched 506 offerings before the adoption of the law. See, matched meaning they're matched on they're matched using PSM propensity score matching based on all the observable firm characteristics and so forth. And again, so here we find that the treated sample, so that is 506C offerings after the adoption of the law, plus 506 offerings which were which could have been which were eligible for which might have been eligible for doing 506C offering before the law. So these treated firms are they're like somewhat older, but the difference is not big economically, and we find that they have they have lower success rate. So after the offering, they have lower success rate and they are able to raise less funds. Okay, so and then the fourth test that we do is we look at the subsample of firms that make both 506C and 506B offerings in the same year. Okay, so we have in our sample there are 223 firms which make both types of offerings in the same year, and we include year fixed effects, and we add firm fixed effects to remove the effects of firm characteristics and to differentiate between project specific effects, or we include, instead of firm fixed effects in other specifications, we include industry fixed effects and state fixed effects. So here are the results. So again, these are the main outcome variables, the two outcome variables, success rate and the amount sold in different specifications. See, and so no matter which way you look, these offerings, they have lower success rate and they are able to raise less cash. Okay. So that's it. Then it's just conclusion. So before we conclude, are there questions? I see there are a number of questions. So Nuri.
Anup, actually, Yuree was active, so that's why we don't have a question right now.
Okay. Okay, very good. So, all right. So then I would just like to conclude. So under Jobs Act, general solicitation has lower funding success, and the mechanism appears to be higher cost, higher fees paid to brokers for finding and verifying accredited investors and advertising. The policy implications of our findings. So our findings cast doubt on the notion that Title II provides greater access to capital markets for small businesses that lack prior connections to investors, And small firms still prefer to raise capital via the traditional 506B offering, that is without advertising, because Title II places tight restrictions on eligible investors, and investors who can participate in these 506C offerings, and brokers charge substantial fees for verifying that investors are accredited. See, so this is, this is, I think what is going on is, the SEC, so the law was passed to increase small businesses access to capital, and giving them the ability to advertise. See, but then in the process, see, they made it, the law has made it somewhat onerous, has limited it to a group of investors, and checking who is eligible and who is not. That's they have made it quite onerous. It's not a checkbox. So the onus has shifted from investors. Who under if a firm is making a 506B offering, the investors just need to check a box, and they self-certify that I'm an accredited investor, or I'm a sophisticated unaccredited investor. Whereas in 506C offering, they need to check using documents, and then the brokers seem to brokers seem to be doing quite well, but the firms, it's not clear that the firms have necessarily benefited. So finally, our results imply the need to craft policies that induce better ways of signaling firm quality, or more transparent approaches to reducing information asymmetry between issuers and investors.
So Anup, we have some last second questions.
Yeah.
Basically, the first question is about like, what is the long run or year by year performance of these issues? Like 1 year horizon, 2 year horizon, 3 year horizon, or like survival rates after the issues?
Survival rates. Okay. So survival. See, so performance. Unfortunately, we don't have data on performance. Performance measures. See, you have to remember, these are private companies, and we have very limited information about them. That's one of the challenges. So even revenue. So all the information that we have, it comes from Form D filings. So even even information on revenue, so we don't know the exact revenue that they have. It's only disclosed in as a categorical variable in brackets. Survival rate, we will look into that to see if we can find some data on that. There may be a way to do that. So thanks for the suggestion.
Sure. The second question is, do firms that switch do that within a year, or even across years? Or do they start with like 506C and then later switch to B, or vice versa? And of course, what can we learn from the direction?
Yeah. It's a good question. Okay, so I have a slide. I did not show, but I think I can. Just give me a second.
Sure.
Learning frequency. Okay, here. I can. Yeah, so I have a slide to answer that question. So here. So this slide addresses that question, learning the frequency of 506C offerings going first by year. So here, this table shows if you look at the first three columns, so these are this is year by year, the number of firms doing 506C offering first, number of firms doing both types of offerings, and then percentage of firms doing 506C offering first. So here you have, so firms do, so initially, so this is like part year, very little data. So in 2014, so that is the first full year after the adoption of this law. So about 45%, just under half of the firms started by trying a 506. See, within this subsample of firms which do both types of offerings in the same year. About 45% of them started off by doing both types of offerings. Then this percentage increased in the next couple of years, but then after that it decreases decreases consistently. Now, so this pattern is consistent with this notion that initially firms were trying to raise capital through 506c first, if they could, and then once they see that it doesn't seem to be working, then that proportion then they try less, the use of 506c goes down. And then here this shows you the success rate of these two types of offerings. If the 506c offering is first, so again this is all for the subsample where firms make both types of offerings in the same year. See, so if the first offering is 506c, so these are the success rates, year by year success rates, versus if the first offering is 506b, these are the success rates. See, so these are consistently lower. And the other thing is the dollar amount sold is these are the dollar amounts sold. But the success rate seems to be lower. Now, one question related to the success rate is, see, so how is this success rate defined? This is the amount of money, it's equal to, so success rate is equal to dollars sold divided by dollars offered. So one issue is, are these issuers inexperienced so that they try to offer too much? See, so they, it's like when they go to raise money, so they might be saying, okay, so we'll, we don't want to turn down anyone who is offering us money, offering us capital. So they may be, they may be either overconfident or don't think enough about reputation effects of keeping the dollar amount of the offering too large. See, so that's an issue of that's a question of you see, which has to do with overconfidence of the managers who might be inexperienced, or it could be they don't think enough about it and then choose the offering size as keep the dollar offering amount as too large, and don't think enough about the reputation effects of doing that. When exposed, it's revealed that they they are not able to raise, they are able to raise only a small fraction of what they were trying to raise.